I encourage anybody to really take their time and do proper vetting more on the people than the deal, because regardless of how good the deal looks on paper, if the people running it aren't on their game, the business plan won't be executed.
Welcome to Raising the Flipping Bar, the go-to podcast for aspiring and seasoned real estate investors. I'm your host, Derek Marlin, and I'm the CEO of Elevation. We're a real estate investment company based right here in Denver, Colorado. We'll dive into smart investment strategies, market insights, and essential tips for scaling your real estate ventures. Whether you're making your first investment or your 100th investment, this podcast is your blueprint for success in the ever-evolving world of real estate investing. Get ready to elevate your real estate game and begin your journey with me. Welcome back to another episode of Raising the Flipping Bar. I'm your host, Derek Marlin, and I'm really excited. I've got a husband and wife team, and we don't get that very often. So we've got super smart investors. We also have fellow podcasters. So this should come off without a hitch. There will be no post-production. It will all be perfect on the first take. We're all good to go. So welcome, Mike and Ligia. Thank you so much for being with me.
Thanks for having us on the show. We're happy to be in studio and doing this.
Absolutely. We're excited to have you guys both. So I always start off the episode, and of course, I want to hear this from both of you guys. I always try to say a fun fact, tell me something different about you, and I'll give some context. It doesn't have to be business related. We've had people that are professional poker players. We have people that were special forces doing crazy missions all over the world. We have people what was there another one? Oh, was a balloon maker. His high school job was doing balloons at like birthday parties. So it spans the gamut. So I would love to have each of you share kind of a fun fact or something unique about you guys.
For sure. For a second, I was going to say you're raising the bar too high, but then you went with the balloon animal.
Oh yeah, no, you gotta kind of bring it back. And the balloon animal guy is actually a super dynamic guy. So we all have different paths of where we go to. But yeah, no, nothing's off the table.
Sure. It's not a fun fact, but it's an interesting fact. I grew up in a communist regime until I was 15.
Wow.
So I have some crazy stories.
It's a very different upbringing experience. Yeah, that's a whole different show we can get into.
And Romania, right? That's where you're originally from? Okay. Yeah. So we got to go at least one, crazy communist regime. Give us one thing that maybe as Americans, we would just have no concept of. And this is not, 100 years ago. So tell us kind of what time frame this is and give me just maybe one little example of like something crazy from your upbringing.
Yeah. Like I said, I was 15 when Ceausescu was killed, but
and that was 89.
That was 89.
Right. Oh, yeah.
But one of the things that probably people just cannot comprehend, like we would have no electricity. And we had no idea when it will come back, like for days or weeks. And then another one is that we only had hot water for 30 minutes once a week.
Once a week?
So once a week for 30 minutes, we had hot water. So my mom, we were 5, so she had to really be so creative about doing everything in that time frame. So
that is so resourceful. And again, I want to put this in context. I know you guys have kids. I've got kids. Everything is the end of the world if we don't get 5G service in 1 second, or we can't immediately, get on TikTok. Or last night we had a networking event at our building and there was intermittent power outages for like 2 minutes and I'm getting frustrated. Well said. You get 30 minutes of hot water for a week.
And I remember those times when we did our homeworks with the candlelight, and we just had no concept of when is it going to come back, when we will have the electricity and all that. But yes.
That's interesting. No, I love it. That's a really fun fact. It's a unique fact. It's something that talks about your upbringing. So thank you for sharing that.
Yeah, it's a big perspective. We have the same thing here. I mean, we talked about it. We had power outage at home. I don't know, sometime a few months back, and we were talking about exactly that. Like when your perspective is set in such a way, like I guess growing up, it was just the way things were, right? It wasn't like, oh my gosh, the end of the world. Her mom was prepared for it. She had, different things. So it's definitely, and then when you go to the younger generation, it's another level of magnitude.
Yeah. Well said. Love it. Thank you, Mike. I got to get your fun fact, your random fact, your crazy fact.
So following that, I'm pretty milk toast.
Okay, that's all right.
American, born and raised, and all that stuff. I guess probably something unique later in life as we've gotten more time from being entrepreneurs and having our land business. I run ultra marathons, so cool. I spend my time out on the trails training for I guess the longest I've done so far is a couple of 50 milers. Later this year in August, I'll be lining up at Leadville to do the 100. The Leadville 100, yeah.
Wow, good for you. That is impressive. So Mike, the Leadville 100, that's an intense race from what I understand. I'm not crazy enough to do that myself, so I'm impressed.
Yeah, it's up in the mountains above 10,000 feet, pretty much all of it. It's a lot of elevation gain and drops. So I don't know if I'll call it a bucket list item, but it's definitely it's been on my radar for a while. So this year at the ripe old age of 56, I'll line up and try to knock that one down.
That's awesome. Good for you. Well, congrats. That's super exciting. Well, I'm so excited to have you guys. Let's get into some real estate. And the fun thing is, I'll put some context for our audience, is that we met just via LinkedIn. I think everybody has to have these grand plans of how you're going to get on podcasts and meet. And that's the cool thing, is that the power of social media and the power of connectivity. It's great to have you guys. You were kind enough to have me as a guest on your show, which was awesome. So I'm excited to reciprocate. You guys have done real estate investing for over 10 years. You've got a lot of experience. The way I say it is, instead of just like, oh, let me hear your backgrounds, give us a couple milestones, summarize your journey so our audience can kind of understand where you guys are coming from as far as, real estate's concerned too.
Sure. My early journey, my dad, he was probably one of the original home flippers. Like, when I was a kid, we moved almost every year. My parents would buy an old house in Fort Worth, Texas, and fix it up, resell it, and we'd be on to the next one. So I think my mom counted one time, and it was, over 20 homes we'd lived in by the time I was 18. Wow. Kind of a deal. And then he went into general contracting when Arlington, Texas bloomed as a suburban type place. And so he did a lot of spec home building, custom home building. So I grew up in that environment, working with the roofing crew or with the, masonry or whatever. I just sweeping out the homes was a big one. Yeah. But, I had a little bit of taste of it, but for whatever reason, I didn't get an entrepreneurial bug. Like, I went to college, my path was going to be a doctor. That didn't work out, but I got more into operations and supply chain and big companies. I was just following the normal path. And so that's how Ligia and I met, actually. I had an expat contract in Romania for 3 years.
Oh, okay.
And so in 2006, I went to Romania. We worked for the same company. We were Nokia mobile phones at the time. And we were building a factory from a greenfield. And Ligia and I both worked for the company there. And we, it was almost an instant romance. But we really didn't get into real estate, I guess, until, we moved back to the U.S. and we're looking for cash flowing ideas. I got back into Robert Kiyosaki, Rich Dad Poor Dad, which, so many people have as a foundation. But it just awakened this thought of maybe I shouldn't just be earning a paycheck, feeding the 401k, and doing things like that. But we didn't really take the plunge. We talk about this, like, we had means. The market was pretty good in the early teens, and but we just never pulled the trigger on a rental property. And it wasn't until we both got laid off in 2016, and the income stopped. So, the paycheck was our source of income. And we had heard on a podcast like this, I was doing some educational stuff, and I heard a couple different people doing land investing or land flipping, basically just buying and selling land. And it sounded almost too good to be true, just the returns they were getting. And so I went down the rabbit hole, and we decided to go all in at that moment. And so our early days were in land. We got into land. We gave ourselves some seed capital. We gave ourselves a timeline and said, if this doesn't work in 12 months, we'll think of something different. But we stood it up, ran it like a business, moved from Texas to Colorado, just went all in on life change. And after about 2 years, we set some hurdles, like, okay, first we need to pay our bills, right? So we need some income coming in to pay the bills. And then, we wanted to replace our salaries that we used to have. And so we just really steadily made quick progress. I would say after about 5 years of that, maybe 4 or 5 years, we got a really big tax bill, and we were like, wow, we have to do something. We have to solve this problem. Yeah. And so that put us in our commercial real estate diversification. And so we thought about it for a bit, and we just decided to go into multifamily, and we went into larger multifamily deals, syndication style, where a pool of investors. And so we've done that combined with land for about the last 4 years, I would say.
Yes.
And so those are kind of the big buckets. And obviously, the last couple of years have not been so friendly with a lot of deals. So we've been on the sidelines a little bit. And, this is a year where we will re-engage. We're not sure if we're going to go back into multifamily or in the same way. We're trying to feel a few things out and decide exactly what we want to do. But I guess that's kind of the broad brush
Yes.
of phases in our real estate career.
And what I would love to kind of hear a little bit about your current structure is, do you guys have certain roles that you focus on? And I say this because I'm fortunate enough to work with my wife, which is awesome. And we have different skill sets. We have different roles. I would love to hear kind of what you each work on. Does it mesh well with what might be your passion? Or are you still in the mode of, I may or may not love this aspect of what you guys are doing, but it's something that's critical to getting done. So maybe if you guys would both kind of dive into where you guys are, how you're splitting those roles, where you're focusing on things. I think the audience would be really helpful, whether it's partnership or a marriage type of relationship with business. I'd love to hear a little bit more.
Yeah, I can start with that. I have been in my career. I have been always in a supportive role, administrative role, and it's something that I enjoy doing. And I also developed the muscle about, sometimes the tasks can be repetitive and daunting, but had that grit to just, doing them and making them happen. And I just love to check things off the list.
Oh, okay.
So I'm naturally really attracted to that type of role. And Mike is more of comes from an operations background, and you can.
Yeah, we mesh pretty well, personally and professionally. Like, I think on a personal level, we have a really strong foundation, I would say. Very supportive. We are in this together. We have like shared goals and visions. And so I think that gives us a really great entry point into work. And for us, I mean, people ask all the time, how do you do it? I couldn't envision it any other way, honestly. It's just, I mean, this is actually why we chose to start our own business, was so that we could spend more time together and do things together.
Yes.
So that foundation really gets there. But yeah, like Ligia said, I come at things with a more strategic, visionary. I fall apart sometimes when it gets down into the weeds of doing a lot of details. I can do it for a while, but then I'm kind of thinking about the next thing already. And so we're a good match in that way. And so when we started our land business, I think we naturally fell into acquisitions and sales. So I was working on market selection, doing some analysis, deal analysis, sending out offers, things like that. And Ligia was more on the marketing and sales side of the business. And so we kind of segmented in that way. When we then diversified into commercial real estate, Ligia took on most, if not all, of the land business and just kept that going. And then I started up our commercial venture, and it was a lot of raising capital, a lot of education of investors, just a whole thing ramped up there. And then now that we've done our coaching business, maybe 18 months ago, I've been in the startup phase of getting that going and marketing it. And Ligia is holding the fort on growing the land business and keeping that going. So we kind of find these natural ways of just making things happen.
And I think what helps a lot is that we're not territorial, and we don't become defensive. Like, we know how to switch we're not just husband and wife all the time. We're business partners, and we're doing a business together. So it helps that we don't become defensive when we give feedback to one another or things like that. I think that helps a lot.
For sure.
Yeah.
No, that's well said. And I'm going to use this as a selfish question, and I think it'll be great for our audience. Do you have a certain trigger or a certain mechanism or something when because you can obviously literally, your work might be at home, so you're taking your work home, you're married, it can be 24/7. Are there times where you guys say, time out, we can't talk about work? Like, I would love to hear how you guys, if that just organically comes up, or if you have certain things where you go, hey, this is enough. Like, we need to just hang it up for a hot second. So I don't know, any tips or tricks for the rest of us?
I think you mentioned it. We, in the evenings, in the afternoon, I think we check out around 5 p.m. every day. And then we don't talk about work. We're just totally focused on ourselves and just relaxing, wind down for the evening. So we try to really keep that, to not talk about work all the time, because it's very tempting.
Yes.
And because we also work together all the time, Mike takes off and he has long runs and he's training, for length. It's very lengthy. So he takes off and maybe goes for a run for like 2 hours every day almost. And I think he has his time by himself. And I do the same. I mean, I do other things, but yeah, we try to be very aware that we shouldn't be talking all the time about work and to separate those things.
I love it. Okay. No, that's really good. I think that's great. Kind of looking at it as the quote unquote 9 to 5 to some degree, of having a structure to some degree, and then, kind of cutting it off. So I think that's super healthy. So that's awesome. I would now kind of love to hear more. Let's get into some more nitty gritty about, maybe let's start with multifamily first, and then we'll go to the land. So give us an overview of the types of deals you guys were doing, some timeframes, definitely dive into some numbers, whether it was running it as a GP yourself, running as an LP. I'll fill in the gaps once in a while. Some of our audience definitely has experience there. Other folks are new to this. So we'd love to kind of hear some more details about the multifamily stuff you guys have going on.
So we got into multifamily, I think, in 2020, right?
Okay.
Just as COVID was running through the country. Wasn't the greatest of times, but there was still deal flow happening. We got into more of a, like I mentioned, a syndication style. And so we were looking at value add deals where maybe it was an older apartment complex that needed some fixing up. It was dated. That was the profile, a little bit the target. They call them B class, C class. So we're talking 80s, 70s vintage type product.
Okay.
Fairly market agnostic. I mean, we were looking a little bit in Texas. We were looking in Colorado, but the deals are, the cost per unit is a lot higher here, especially in the Denver and even in the Springs. But that's a little bit what we were going after. I would say 100 unit plus type product. And so our journey, I would say, we started as passive investors, limited partners.
Yep.
And so we joined a couple of deals as limited partners just to understand. We also joined a group, and we had a mentor that was helping us along the way. And so, we wanted to learn the ropes and not just jump in to some of these big deals blind. But our early deals were as limited partners. We invested in a couple of deals in Fort Smith, Arkansas. Okay. They were great deals. I think in 2 years, between the second and third year, went ahead and exited. And, the business plan had been achieved. We doubled our money in those deals. They were great deals. We invested in a few more deals, a couple in Texas, a few in the Midwest, in Iowa, Des Moines. Okay. And our arc was, we started as limited partners, and then we joined as a general partner, part of the team. We quickly discovered that for these types of deals, especially in that time period, the market was so hot. There was so much deal flow. It was all about bringing capital and investors in to get deals closed. And so that wasn't our thrust when we started, but we quickly figured out that was the most value added part of the partnership. Okay. Was being able to bring investors into the deal. And so we started doing a lot of education, working social media, reaching out and bringing in an investor base, and so that we could participate. And that's largely what we did on our next few deals. Was we went on site for due diligence. We helped with a few other aspects, investor communications, but it was largely bringing capital into deals. And then we just graduated up to leading our own deals. And so we had a couple deals where we were the lead sponsors and kind of put the team together. I had 2 other partners plus our mentor. So we had like a core team of 4, but then our general partnership team was maybe, 15 people or so that was helping on that. And so that was our arc. And like I mentioned, for about the past 18 to 24 months, I would say we've really just been waiting out the market. Rates ran up, deal flow locked up. There really hasn't been much. And I would say maybe in the last 6 months, there starts to become more distressed properties, some, deals that got into interest rate crunches and things like that. They're underwater. And so we start to see a little more deal flow. Ligia and I aren't sure. Syndications are a lot like flipping. Yeah. I mean, it's really just a longer term flip. And I don't think we really went into this with that expectation. We want more investments that we can hold as long as we want to. And so we'll probably pivot into maybe a smaller value on multifamily, and that may mean smaller sizes or whatever, or get into storage is a appealing. Triple net leasing, I'm not sure about. That's is something we were looking at, but we'll have to see what happens with office, and it's very niche play, I would say. And so 2025 for us is really about, we need to re-enter some commercial aspect, but it's with that vision of something that it could even be single family rent homes or something. But we're at a stage where we're very active right now.
Right.
But in 10 years, I want to have established some assets that are cash flowing, maybe paid off or paid way down, and we can step back if we want to, kind of a thing.
And I think you kind of perked my interest in a couple of things to kind of frame it for our audience. Yeah, give me a sense of what was the purchase price of, and I'm sure every deal was different, but roughly the purchase price on some of these deals, the number of doors, so people can kind of get their arms around it. And then I would love for either one of you guys to hit on the returns too. I think you said you doubled your money, which is awesome. I think people have, need an explanation or as we can educate them of what you guys are earning on an annual basis, and then obviously getting your capital back. So maybe just dive a little more into the numbers. Again, can be kind of overarching, doesn't have to be deal by deal.
Yeah, the typical deal size that we were purchasing at that time was around 15 million purchase price. And so our early deals, the loan to value was really favorable. Like you could get 80% loan to value. So the bank would put up, 80% of the capital, and you'd have to bring the other 20 in the form of other investors and even private equity in some cases. And so that's kind of the going in price. The typical way the syndications were structured were, buy an undervalued property or a property that needs some sprucing up.
Yeah.
You come in with your business plan. That's brought to the table as well, right? So you put together a package for renovations and all of that. Yeah. The target was typically to have that renovation completed and then the property stabilized, so brought back up to 90+% occupancy and revenue coming in pretty regularly, and then do a cash out refi, right? So pay back to the investors. And so the typical investor profile is, let's say you're putting in $100,000 into one of these investments. Well, you get a big chunk of that back in year 3. Cash flow builds over that time. So in the early first year, for sure, there's really not a whole lot of cash flow coming out because you're in a renovation project and the capital is going in there. And then after about the 5th or 6th year, there's typically an exit plan. So you've stabilized, rents have risen a certain amount, and that's when a bulk of and so I would say for an investor, it's largely a 2-phased delivery on, that first cash out event is really getting your capital back, or a large chunk of it. And then whatever's residual at the end of the sale is the return on your investment. And the typical profile back then was double your money in 5 to 6 years, right? So put the 100,000, you get your 100 back plus another 100,000. Some of the early deals, like I mentioned, were home runs. They did great. Some of our later deals, they struggle just because the market locked up. There were a lot of deals with variable interest rate, and maybe they didn't have a rate cap there to protect on the upside. And so there's a lot of deals coming back into the market, but we passively invested in a few deals that just went sideways, and we were lucky to get our money back. Okay. And so it's not always roses in these deals, right? I mean, there is a downside, and I think a lot of people, when we talk to investors, this can be a misunderstanding: is that, hey, we're buying an asset, we're going to own an asset, but you don't really own the asset, right? The bank owns the asset, and so if the business plan goes sideways or even gets underwater, the worst case is a foreclosure, and people can lose everything. So we've kind of had a mixed bag in our. I think we were in 6 different syndications, actively and passively, and like I mentioned, the early ones were home runs, and we were like, great, this is we're gung ho, and then some of the other ones were locked up, and we're still in a couple that we're riding out, and so there's a promise of still some things, but that gets tricky as well because there's cash infusions, and you have to decide, is this is it going to work out in the long term and stuff. And so, yeah, it's a tricky investment class. And I would say, having been in it, you really have to be careful, as with anything, when you're partnering with somebody. Who are you partnering with? What type of character do they have? And a lot of times you don't understand that until you go through crises, right? You don't understand, is somebody going to shut down, or are they going to lean in? Are they in this for the long haul, or are they out? And so um, I would say, especially in our early deals, we were fortunate to have really good returns, but we learned very quickly, like, we don't really know these people in a lot of cases. And when you're a passive investor, that can really be the case. And now there's even this extra layer of fund managers. And so there's, you're putting your money into a fund, and then the fund is going off and finding deals. And it just really, I encourage anybody to really take their time and do proper vetting, more on the people than the deal, because regardless of how good the deal looks on paper, if the people running it aren't on their game, the business plan won't be executed. And so it really, really have to be on your game.
So we're going to take a quick break and tell you about the next Elevation Academy. If you're looking to dive deep into real estate investing, this is definitely the event for you. Our academy features over 100-step process to help you navigate every single thing from market analysis all the way down to every aspect of project management. So this is tailored for both beginners and seasoned investors. And our one-day intensive training will equip you with the strategies and insights needed to elevate your real estate investing game. Spots are definitely limited, so click on the link below in the show notes to sign up and transform your approach to real estate investing. Okay, let's get back to the episode. It's bringing back memories for me. So I had a similar experience. We did multifamily investing in the Cincinnati, Ohio market. So we sold everything in Colorado. I was the general partner. And then I kind of really straddled both sides of the fence. So as the operating manager, the GP, the general partner, and then I invested as a limited partner. And I think people really appreciated that we had our money in all sides of the table. But you guys bring up a great point. Like, stuff can go sideways. We had a phenomenal year one, and then year two was super rocky. And just kind of from old school values, I was like, not that it's their fault. They sign a 70-page private placement memorandum that essentially signs our whole lives away, that says we could all have all our money flushed down the toilet. But I was like, not to say I should have been there more often, but I just felt personally responsible. So I just personally funded what we needed to do for that short 6-month turnaround. And I think I just stole the concept from Warren Buffett of doing the investor updates and getting ahead of it. Just be super honest, super upfront, tell them hey, we come across this crazy thing where we quickly learn, which it's a funny market where Cincinnati is actually in Ohio and in Northern Kentucky. So we had assets in different states, and we quickly figured out that Ohio is much more tenant friendly and Kentucky is much more landlord friendly. So we're trying to your point, execute a business plan that was somewhat similar, same market or MSA city, but they were two very different things. So I kind of went back to our investors and said, hey, this is happening in our Ohio stuff. This is crazy. We never thought that we'd come across this, but essentially it was evicting people in a crazy drawn out long process. So we couldn't turn units as fast as we wanted to. And then the Kentucky ones were just cranking. So yeah, it was just like fall on your sword, fund it personally, and then give better, returns on the back end. And then it's probably the same time period. We bought that in 2017, and then we exited 2016, we exited just pre-COVID. So I think we honestly lucked out there, but values just went up way faster than I thought. We got it stabilized. You could we raised friends and family money. It was a syndication, but you just kind of got the sense like, let's just pay everybody else off, and let's have great returns, and let's live to fight another day. So you're right. You can have these great visions of grandeur. It just doesn't always work.
Yeah. I think for us, having done land where we used all of our own capital, deals are incredibly low risk. It was just a different world, and having gone into the multifamily syndications where you're responsible for other people's money, and there's all these moving parts and rents and legislative type. I mean, there's just so much happening. We have a hard time wanting to leave land. I mean, it's like okay, we'll just do this bread and butter, easy stuff all day long. Cash comes in, and but the downside of land is there's no tax depreciation or benefits in that way. True. And so it's all capital gains for us. And so we need something to offset that. but we can do that passively. If
Yeah.
we,
No, and that's smart. And that's going to be my next question is, Ligia, I would love to kind of hear, it sounds like from your earlier comment, Mike, that if you've got two great roles, you're both doing different things. If you're kind of focusing a little more on land, I'd love to kind of have you take us through what is and I'll use a sports analogy. That's kind of my background is everybody talks about the huge home runs. Nobody shares the losses, and that's okay. We don't need to talk about that right now. But like, tell me what an quote unquote average land deal where you're happy, but you didn't crush it. Walk us through kind of through what you're doing right now and maybe your role on the land side of things.
Oh, sure. So I want to start with saying we have never lost money on a land deal ever.
Love it.
We may not get on each deal the same profit percentage wise, but on the whole portfolio, it's amazing.
and I'll just
Great.
butt in here quickly, but in real estate, they say you make your money on the buy. It's
Yes.
kind of one of the adages. Well, it's exactly the business model in land. And
Mhm.
so we only buy land if we are buying it 50% or less to market value.
Okay.
And so there's a lot of room to play in there if things do go bad, which very little goes bad. But
Yeah.
you could talk about some actual deals.
Yeah.
Sure. So we basically reach out to owners, direct reach to owners, and we don't buy necessarily properties on the market,
Okay.
but off market. And like Mike mentioned, we make a specific offer. It's 50% or less than the market value. And many people just want to get rid of their properties. They're people that have inherited or life changes, spouses pass away and stuff like that. So a typical land deal for us these days, that definitely market has changed
Yeah.
throughout the years. But like how we would buy a property for 5K and turning around and sell it for 15K.
Okay.
So we triple our money
Okay.
without doing anything to the land
Nice.
and without touching anything. No sleepless nights,
I
no
like that.
termites, no tenants.
I like that. And tell us where are you doing this? What part of Colorado? Is it all Colorado land or is it in different states too?
We have done business in different states,
Okay.
but we typically like to stay. The majority of our deals are in Colorado, in southern Colorado,
Okay.
rural area,
Okay.
Park County. We do a lot of business there.
Okay.
There are other counties in South Colorado where there's a lot of people that would love to build a cabin one day, would love to go out there and hunt. They love the recreational aspect of things. They want to go camp on their land, and so we kind of do deals there.
Yeah, the business model works across different types. You can do residential, rural residential, farmland, commercial, infill lots. It really, it's just we have gravitated towards the Colorado lands because we love it,
Yes.
and so
Yes.
it's also close. We don't have to go look at the land. We buy a lot of property sight unseen and flip it sight unseen.
Okay.
But every once in a while, we'll go out for a day and take some photos. I have a drone. I'll go out and play around with the drone and stuff like that, just to do things that we haven't done it in quite a while. But yeah, to Lygia's point, we buy and sell. I would say all across the Southwest,
Okay.
just because that's where we have focused. But we have clients that work in Florida, in the Carolinas, in Georgia. I mean, land is everywhere. There's hundreds of millions of acres of vacant land in the U.S. And so the business model works.
Also, a lot of what we do, we own our finance. When we sell our lots, we own our financing it. So there are many people that have that dream of owning land and they don't afford to buy it outright. So we do that, and then we can actually we can have and charge a premium price because people don't care so much. They care about the monthly payments that's affordable to them. They don't look so much about the end price. So we kind of stack up a lot of those notes, that people pay in installments on a monthly basis. And we try to typically get our money back between 10 and 12 months.
Okay.
So we get our investment back, and then from there on is like pure profit. And our typical loan length is like between 5 and 7 years.
Gotcha.
That's the sweet spot where people are comfortable. having a loan with us for like between 5 and 7 years.
And we're comfortable.
And we're
That's how long I go
comfortable.
And you're comfortable, yeah, being in that timeline. Okay, that makes sense. Talk maybe a little bit more about who is your back end buyer? Who are you finding as the person to purchase this land? Because in our world, in the traditional quote unquote fix and flip wholesale world, we're always trying to build up our cash buyer list and the people that on the back end that are going to buy it. Obviously, that's a huge, bottleneck to what's going on. Talk about who like buys your stuff on the back end.
Yeah, it's just people. I mean, we're selling to just people that want land. I mean, it's an end user. It's typically, I would say, a lot of couples, family people, but they're just looking for. I mean, a lot of what we do is 5 and 10 acre tracts, like Ligia said. They're probably between our cost 5 and 15,000. We're selling them for 15 to 35 or 40,000, depending if it's a cash deal or financed. And yeah, it's just people that want a vacation property or something. And so we do a lot of our marketing on just open channels, Facebook Marketplace, Zillow, the MLS. It's just, end user people.
And some of them are hunters. Some of them have the stream of,
bigger
I
tracts
just
will go
want
with
to go
hunters,
and
yeah.
hunt on my property. Those are bigger tracts for sure.
That's perfect.
But similar to really all real estate asset classes, the land industry or this niche has a wholesale market in between. And so there's, sometimes we find owners that have 20 properties. And if we get them really cheap, then sometimes we'll liquidate half of those on the wholesale market just to get cash coming in, and we'll pay for our purchase and retail the others. And conversely, if we get low in inventory, we can go to the wholesale market and just, hey, we need to pick up, and we'll sacrifice a bit of margin, but there's still enough in there for everybody to win. And so there are all these layers. Ligia mentioned we do a lot of owner financing. Well, that's in the form of a promissory note. And so there's a whole note buying marketplace where people will buy, a portion or all of your notes. Just a lot of different ways to play in the industry.
Yeah. Okay. Perfect. So we're kind of wrapping things up on land because I want to be sensitive to your time, but that's super fascinating to me. And it's funny that I'm going to have to give my wife Ann a hard time and have her come listen to this episode, because we are the proud owners of 2 pieces of dirt in the middle of nowhere in Florida. And they were gifted to her from originally my father-in-law's father, so my wife's grandfather, did a ton of land in Florida Central Florida, when things were booming. Golf community in the 70s, to your point, Mike, just tons and tons of plots. He bought tons of stuff, had everything, and then slowly kind of retired and sold stuff off. And then I think my father-in-law inherited, 5 pieces of dirt or whatever. So my wife and my sister-in-law, that was their graduation present, is they got, a piece of land in Florida. So we did, visit our piece of vacant property, as we see now on the completely undeveloped side of this golf community that's kind of been taking. And it's a hard one, because this is probably some of your buyer profile. We get letters all the time of people that want to buy our stuff. We rode the wave up pre-housing crash to, I think the assessed value is like $4,000, like it's nothing to write home about. And we got up to the low $30,000 price point. Of course, 2006. And we had just gotten married. We're having kids. We're like, oh, this is perfect. We're going to put our kid through college with this, or, go buy an actual vacation property. And then the housing crash happened. And if you've seen the movie The Big Short or read the book, a lot was going down in Florida, obviously. So needless to say, that tanked to like $300 2 years later, and we're now building it back. It's this ridiculous roller coaster we're riding. So we've owned this property now, really my wife has, for 25 years. And we're now in the $10,000 range. Now we have kids going to college. So I'm actually like needling my wife in. I'm like, hey, what are we going to do with this? Because we are paying $500 a month in HOAs and property taxes. So like, it's not nothing. We should have sold it year 1, but it's just been interesting to see this crazy ride. And to your point, you get the letters of people that are willing to make an offer, and we know who's legit and who's not, because we're weird and perverse. And so we immediately text people back and say, great, give me your highest and best. And nobody calls back. So it's just this interesting thing. So if you're just diligent, you probably get tons of deals by just not sucking, is like this ridiculous phrase that we have, so
we say that all the time. I mean, it's incredible how many people we've gotten back to, and they're like, oh, you're the first person who's responded to me. And
yeah. And they're paying for direct mail, like you're putting stamps out there. So It's just funny. But I would love to kind of, as we wrap up here, it's been so fun having you guys on the show. I would love to, I was a great guest on your podcast, but I would love for you guys to kind of tell us in our audience your transition of how you got into podcasting and how it's been going. And they'll definitely check out your podcast, but tell us about Cash Flow Fight Club.
Yeah. So I guess the Cash Flow Fight Club was born out of one, just personal desire to explore other cash flowing businesses and things like that. And but I didn't really want to just do another, there's so many people out doing podcasts today, and how do you differentiate? And so these are great. I love these conversations. We do a lot of these on ours, like we did with you. But the genesis of the Cash Flow Fight Club was really to pit two different businesses or investment types together and have them go head to head and debate, pros and cons, as a way to tease out, as you were saying, everybody comes and pitches their home runs and says, oh, this is great, all this kind of stuff. It was a way to have people be able to pick apart and go, oh, but what about this? Or, and get to the ugly underside of some of these investments. And so that's how we kind of came up with the Cash Flow Fight Club. And it's been a lot of fun. It's a lot of work. And when you add two guests and just trying to find investment types or business types that are close enough, but there's enough differentiation. I mean, it's a lot of work. And so we have drifted away. We do those infrequently, and we do a lot more of these one-on-one style, where we talk to, other people, not always in real estate, but that's our network and our world. And so we gravitate towards a bit of real estate, but we really like to dig into mindset, personal development. How do people get successful and stay successful? Do they have habits or belief? That's really what I like a lot more than talking about business. And so we may pivot the podcast here in a little bit to be more focused on just behaviors and high performance things. But that it's kind of gotten a bit more because that's where we like to gravitate and talk and stuff. But we have a lot of fun with it. I mean, it's coming up on 2 years, I think. Which is a long time to be doing a show. They're not easy, as you know. I mean, it's it takes time, and so, but we have fun doing it. We meet great people like this. I mean, this is the reason, right? We don't have a Joe Rogan podcast. We don't have a Rich Roll or whatever, right? We're not monetizing. It's not our livelihood, and so for us, it's a lot of networking and exposure to different business ideas. People do ice vending machines in Florida, actually, and different stuff. So it's a lot of great information. But we love doing the podcast, and I don't know, we revisit every quarter our intentionality behind it, and
it's really fun for us.
That's good. And I think you're right. It is a lot of work, and there's an expense to it and stuff. So it wasn't at least enjoyable. There's the nice long-term branding and business development plan. But if it's not fun, then it's not worth it. I agree. It's too much. And actually, as an aside, thank you for driving here. You guys came up from Southern Colorado. We tried to schedule this when you guys got way more snow than we did. So we love having you here in person. And I would love to kind of have you guys share. Well, first off, how do people get a hold of you? Let's make sure we don't gloss over that. So how can our folks get in best contact with you guys?
Yeah, the best way would be to go to our website, flippingdirt.us. And if you go to flippingdirt.us/freedom, I've put together a landing page that has our contact information. If people want to set up an appointment, schedule a call, or if they want to send an email, or our phone numbers there as well, I believe. There's also a few free resources on what land investing is all about, how to get involved. It's kind of a one-stop shop. So if somebody wants to go there to flippingdirt.us/freedom, they can kind of launch into whichever direction they want to go.
Okay, perfect. Awesome. Well, Mike and Ligia, thank you so much for joining us on Raising the Flipping Bar. Hopefully you guys got a ton of value out of this. It's just so fun to see people doing different types of investment. Like we said, we've all had some home runs, but it's cool for you guys to share, some of the trials and tribulations. So I really appreciate it. Thanks you guys for being with us. Thanks you guys for listening, and we'll catch you guys on the flip side. Thanks for tuning in to this week's episode of Raising the Flipping Bar. If you found value in our insights and stories, let's keep the conversation going. Connect with me on social media and be sure to share this episode with friends or colleagues who might benefit. Your feedback and reviews help us grow and reach more listeners like you. So please If you enjoyed this episode, leave us a review. Thanks again to the Elevation Academy for sponsoring today's show. If you're interested in learning more, click the link in the show notes below. And remember, every property tells a story, every deal brings a lesson. Keep reaching for those goals, and we'll catch you on the flip side. Hey, everybody. Thank you so much for listening and watching Raising a Flipping Bar. Just a basic overall disclaimer is that A, this is not legal advice. B, this is not tax advice. C, this is not financial advice. I hope you get the gist, but I'm obviously not a lawyer, not a CPA. Hell, I'm not even a real estate agent, actually. But in general, we hope you get a ton of value out of this, but there is a bit of a disclaimer. Please consult a professional if you have any questions whatsoever. Thanks.